Most people who want to build wealth spend 5 years doing the same thing, earning more. They chase the raise. They take the side hustle. They grind harder inside an income bracket that, no matter how high it climbs, never seems to produce the distance between them and financial pressure that they expected. 5 years pass. They have more to show for it than they did before, but they are not wealthy. They are better paid versions of the same person they were. Here is what nobody in mainstream financial content wants to say plainly. Income is not the variable. The variable is deployment. What actually separates the people who come out of a 5-year window with meaningful, compounding, structurally durable wealth from the ones who come out with a slightly larger paycheck and a slightly larger credit card balance is not how much money came in. It is what happened to the money after it arrived. This video is a blueprint, not an inspiration reel, not a motivational framework dressed up as financial advice. A specific, sequenced, realistic map of what the next 5 years look like if the goal is actual wealth, not the appearance of wealth, not the performance of financial ambition, not a savings account that feels impressive until rent is due. Before that map starts, you need to understand what is working against you. The financial system you were born into was not designed to make you wealthy. It was designed to make you a reliable customer. Every bank that offers you a savings account paying 0.01% interest while lending your deposits out at 7, 12, 18%, that spread is not accidental. Every credit card that lets you carry a balance, conveniently, while charging 24% annually, is not a service. It is a product. You are not the customer of that product. You are the revenue source. The school system that spent 12 years teaching you quadratic equations and never once explained compound interest, tax-advantaged accounts, or the difference between an asset and a liability. That omission was not an oversight. Financial illiteracy is not a side effect of a flawed education system. It is a feature of an economy that runs on consumer spending, which runs on people not understanding the cost of debt. That is the villain in this story. Not your income, not your discipline, not your starting point. The system. And the only way to build wealth inside a system designed against it is to understand its mechanics well enough to stop being its product. So, the blueprint. 5 years, 4 phases, 1 non-negotiable principle running through all of them. The principle: wealth is not built by making more money. Wealth is built by making your money make decisions you are too busy to make yourself. Every phase in this blueprint exists to get you closer to that condition, where capital is working independently of your time, compounding in the background, producing outcomes that have no relationship to how many hours you worked last Tuesday. That is the architecture. Here is the map. Year 1, the diagnostic year before a single investment decision is made, before an account is opened, before a strategy is adopted. Year 1 is about clarity. Most financial plans fail, not because the strategy was wrong, but because the person executing the strategy had no accurate picture of their actual financial reality. They guessed at their monthly expenses. They underestimated their fixed obligations. They overestimated their available capital. They built a plan on a fiction. The diagnostic year has 3 components. First, the real number. Not what feels like your income after you pay your major bills. The actual number. Gross income, after-tax income, fixed obligations, variable spending, and the gap between all of it. Most people who run this exercise discover the gap, the money that actually has nowhere committed to go each month, is different from what they assumed. Sometimes it is smaller. Sometimes it is meaningfully larger than expected because spending was never tracked precisely enough to know. Second, the debt map. Every debt on a single page. Balance, interest rate, minimum payment, payoff timeline. Not to induce shame, to produce clarity about what is costing the most. High-interest consumer debt, anything above 10%, is a return problem. Carrying a 20% credit card balance while investing in an index fund returning 8% annually is mathematically equivalent to burning $4 out of every 5 you put into the market. The debt map makes this visible before the investment conversation begins. Third, the system audit. Every automatic payment, every subscription, every recurring charge that was set up and then forgotten. every monthly dollar leaving the account without conscious allocation. The system audit is where most people find $200 to $400 a month they cannot account for, not because they spent it irresponsibly, but because the architecture of modern financial life is designed to route money out of your account before you have made a decision about it. Year 1 ends with 3 numbers clearly in view: available monthly surplus, total high-interest debt, and the monthly amount that will be systematically deployed from this point forward. That last number is not negotiable. It does not go up and down with how the month felt. It moves before anything else moves. This is what financial systems call paying yourself first. But the framing misses the point. You are not paying yourself. You are removing the money from the decision-making environment before the decision-making environment consumes it. If you are still watching, the next section is where most people stop. Not because it is complicated, because it requires honesty about something most financial content will never ask you to examine directly. Year 2. The foundation year 2 things happen simultaneously in year 2. High-interest debt is eliminated aggressively, and the first investment position is built in parallel. The conventional advice is to eliminate all debt before investing. The conventional advice is wrong. Specifically, the correct framework is a rate threshold. Debt above 10% annual interest destroys returns faster than investment can recover them. Attack it first, hard, and completely. Debt below that threshold, a 3% mortgage, a 4% student loan, costs less than a diversified market position historically returns. Paying it off aggressively at the expense of early compounding is the mathematically inferior choice, even if it feels psychologically cleaner. This distinction costs people years of compounding time that they cannot get back. The first investment position is not exciting. It is a tax-advantaged retirement account, an employer-matched plan where one exists, because an employer match is an immediate 100% return on the matched portion with no market risk. Nothing in investing comes close to that return profile. If an employer match exists and is not being captured in full, that gap is the most expensive financial decision in the entire 5-year period. Beyond the match, a broad market index fund inside a tax-advantaged account, not individual stocks, not sector bets, not a strategy that requires regular active management. The research on this is not ambiguous. Over 15 and 20-year windows, actively managed funds underperform passive index strategies after fees in the overwhelming majority of cases. The edge that active management promises does not materialize at the scale or consistency that justifies the cost. Year 2 builds this position every month, without exception, regardless of what the market is doing. This is where the noise becomes expensive. Every market correction produces a wave of content explaining why this time is different, why staying in the market is reckless, why cash is the only safe position, why the next crash will be unlike anything that came before. The financial media ecosystem runs on this cycle. It generates anxiety that produces behavior, selling, pivoting, pausing contributions, that statistically reduces returns for the people who act on it. The investor who contributed through every correction of the last 30 years significantly outperformed the investor who tried to time around them. This is documented, studied, and consistently ignored by the content ecosystem whose revenue model depends on you believing otherwise. Year 2 ends with high-interest debt eliminated, a systematic investment contribution automated, and, most importantly, the emotional discipline of watching a market position move without reacting to it beginning to develop. That discipline compounds alongside the capital. Year 3, the expansion year. Something shifts in year 3 for most people who reach it intact. The monthly surplus is no longer going toward debt. The investment contribution is automated and invisible. It leaves before the rest of the money arrives in a spendable account. The cognitive load of active financial management drops significantly. This creates capacity, and capacity in year 3 has a specific use: the income layer, not because the primary income is insufficient, but because a single income source is structural vulnerability. One income stream means one decision by one employer or one market shift can pause the entire plan. The wealth-building research is clear on this. People who reach financial independence fastest almost universally develop a secondary income stream that either complements or eventually exceeds their primary one. The income layer in year 3 does not need to be large. A secondary stream generating $500 to $1,000 a month from a skill-based service, from a small digital product, from content that earns passively, from consulting in an existing area of expertise, materially changes the math of the following 2 years if all of it is deployed directly into investment and is never absorbed into lifestyle. This is the rule that breaks most people who reach it. Secondary income is not a lifestyle upgrade. It is an investment multiplier. The person who earns an extra $800 a month and spends it on a nicer apartment has not moved the 5-year blueprint forward. The person who routes all of it directly into assets has doubled or tripled their monthly investment rate without changing their lifestyle at all. Year 3 is also when real estate enters the picture as a concept worth serious evaluation, not necessarily execution. The analysis here is specific. Does a real estate purchase in the relevant market, at current rates, at current prices, cash flow positively after all costs, including maintenance, vacancy, and management? If it does not cash flow, it is not a wealth-building asset. It is a speculation on appreciation, which is a different and significantly riskier strategy than the blueprint supports in year 3. If the numbers work, if a property can be acquired with the capital available, financed at a rate that allows positive cash flow, and managed without destroying the time available for the primary income, year 3 is the right moment to consider it. If they do not work, the blueprint does not require real estate. It requires systematic capital deployment into compounding assets. Real estate is one vehicle. It is not the only one, and it is not always the right one. Year 4, the leverage year. By year 4, a specific phenomenon is visible for the first time. The investment position is producing returns that begin to feel meaningful as an absolute number. Not life-changing yet, but visible. The compounding that was invisible in years 1 and 2, because the base was too small for the percentage gains to feel real, starts to register as actual dollars. This is the moment most people make the most expensive mistake of the entire 5-year period. They increase their lifestyle. Not dramatically, not irresponsibly, just, the income has grown, the debt is gone, the account has a number in it that feels like permission to breathe a little, to spend a little more freely, to stop being so rigorous about the monthly surplus. This drift costs more than almost any other single financial behavior over a 5-year period. Not because spending more is wrong, because lifestyle inflation is structurally self-reinforcing. The upgraded apartment requires the upgraded neighborhood, which requires the upgraded car to match the address. The spending floor rises without a decision being made about it, and 3 years later, the surplus that was being deployed is almost entirely absorbed by a higher fixed cost structure. Year 4 is the leverage year because it is the year the discipline established in years 1 through 3 either compounds or evaporates. The specific move in year 4: increase investment contributions proportionally with any income increase. If income grows by 15%, contributions grow by at least half that before the lifestyle has time to expand to absorb it. This is not a sacrifice. It is a sequencing decision. The lifestyle upgrade is deferred by 12 to 24 months. The compounding continues uninterrupted. By the end of year 4, for someone who has executed the blueprint with reasonable consistency, the investment position is producing passive returns on a base large enough that the psychological relationship with money has begun to shift. The anxiety that characterized year 1, the fear of an unexpected expense, the feeling of being one bad month away from real difficulty, is structurally diminished, not because the number is enormous, because the system is built. Year 5, the architecture year. Year 5 is where the blueprint stops being a budget and starts being a structure. The investment position is now large enough to require intentional allocation rather than simple accumulation. Diversification becomes real, not across 12 different index funds that all move in the same direction, but across genuinely uncorrelated asset classes: domestic equities, international exposure, fixed income, real assets, and potentially alternative positions depending on risk tolerance and tax situation. Year 5 is also when the tax conversation becomes non-optional. Most people in the first 4 years of a wealth-building plan pay too much in taxes, not because they are doing anything wrong, but because they have not yet optimized the structure through which their income and investment returns flow. A tax-advantaged account structure, combined with understanding of capital gains treatment, loss harvesting, and the difference between ordinary income and investment income, can mean the difference of tens of thousands of dollars over a 10-year compounding window. This is not tax avoidance in any meaningful sense. It is understanding the rules of the system well enough to use them the way they were designed to be used, by people who have access to competent advice, which historically meant only people who were already wealthy. That information asymmetry is no longer as complete as it was. The tools exist. The knowledge is accessible. Using it is the architecture work of Year 5. By the end of Year 5, if the blueprint has been executed with consistency rather than perfection, most people find themselves in a position they could not have clearly pictured from the start of it. Not retired, not financially independent in the complete sense, but structurally different in a way that is genuinely difficult to reverse. A compounding investment position, a secondary income stream, no high-interest debt, a tax-optimized account structure, a monthly surplus that is deployed automatically before it can be spent. That is not the finish line. That is the infrastructure that makes everything that comes after significantly more likely. Save this video, not because the information is rare, though most of what mainstream financial content serves people is more about anxiety management than actual architecture. Save it for the moment. 3 months from now, 6 months from now, when Year 1 feels slow and the temptation is to skip ahead to the exciting part. There is no exciting part. There is a system, and systems work because they are relentless, not because they are dramatic. The question this video cannot answer is the one that is actually most important. Why do people who understand all of this still not do it? The knowledge is not the gap. Something else is. That something else is the subject of a different conversation and a different video. If this channel is the kind of place you want to spend more time, this is not content about feeling better about your finances. It is content about understanding them well enough to stop being the product and start being the owner. That distinction matters, or it does not. If it matters, you are in the right place. The next video on this channel addresses the one thing that derails more 5-year plans than any market correction, any income disruption, or any strategic error: the psychology of the plateau, and why the people who break through it almost always have one specific thing in common that has nothing to do with money. Drop a comment with the year you are in: 1, 2, 3, 4, or 5. Not where you want to be, where you actually are. The comments on the last video that asked a version of this question were more honest than expected, and more useful.